Welcome to my channel. I'm Scott, and if you want to catch my newest video, I post one every day. In this video, I'm going to walk you through the process of valuing Snap stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Snap is a social media company founded in 2011. The company developed and maintains a number of products, mainly Snapchat, Spectacles, and Bitmoji. The original name of the company was Snapchat, but it was rebranded as Snap to include Spectacles. Snapchat is a messaging app. One of the main features of Snapchat is that pictures and messages are usually only available for a short time frame. Snapchat has over 200 million daily active users, and 4 billion snaps are sent each day. It's mostly popular with kids 16 and under. Spectacles are smart glasses dedicated to recording video for Snapchat. Let's get started with the model. This is a large cap company, 94 billion market cap. They're trading at $62 a share and they have 1.5 billion shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. So the company does have negative free cash flow every year. Net income is the profit and loss on the income statement. That's revenue minus expenses. They also have negative net income every year. Revenue is the sales for the company, and that's growing at a rapid pace. It tripled from 2017 to 2020. This is the company's income statement. The top line is the revenue, the sales. Below that is the cost of revenue. The difference between those two numbers is their gross profit, and their gross profit has went up a ton since 2017, from 100 million to 1.3 billion. Then below that is operating expenses. Examples are depreciation and research and development. Then below that is their operating income, and they have negative operating income because they are aggressively growing their brand. Below that is the interest they pay in their debt. And below that is other income and expenses, which is usually impairments or other non-cash gains and losses. Then you have your pre-tax income, then your taxes, and the bottom line of the income statement is their net income. And it is negative every year, but it is improving. It was negative 3.4 billion, now it's negative 1 billion. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company loses from its operational business. Then you have capital expenditures, which are investments in property, plant, and equipment. Operating cash flow minus CapEx gives you your free cash flow. And they do have negative free cash flow every year, but it's getting a little better. Since the company has negative free cash flow, it needs money from somewhere to run its business. The company received $2.7 billion of cash when they IPO'd in 2017. They also took on $1.3 billion of debt in 2019 and $1 billion in 2020. The most important part of any business is their operating cash flow. If you cannot generate positive operating cash flow at some point, you don't have much of a business because you cannot rely on debt and equity financing to run your business in the long term. This company has never generated positive operating cash flow. Net income is your accounting profit and loss. You could think of operating cash flow as net income converted to cash. And the way you calculate operating cash flow, you start with net income. Then you have to add back the non-cash items on the income statement. They had $87 million of depreciation. That's a non-cash expense that brings down your net income, but it doesn't affect cash flow. They also had $770 million of stock-based compensation and negative $150 million in changes in working capital. So even though they reported a $1 billion loss, they actually only lost $170 million in cash flow. Let's look at a capital structure. $2.3 billion of equity, $2 billion of debt. So they're 54% equity, 46% debt. And they could pay off all the debt with the cash on their balance sheet and still have $500 million of cash left over. Their WACC is 7.5%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year for, that's 85 billion. We discounted those numbers back to today's new weighted average cost of capital. We get a value of the company of $68 billion. We divide that by 1.5 billion shares. And we get a calculated stock price of $45. They're trading at $62, so they're trading at a 36% premium. It's a sell according to the model. Simply Wall Street values the company at $34, so they're even lower than me. It's hard to value a company with negative free cash flows, so you have to look at the growth in revenue to try to figure out if they'll become profitable at some point. And the way their revenue is going, it looks like they will become profitable pretty soon. Once they pass that break-even point, then the money just flows in. Like it did with Amazon, they were investing so much in their business and they had so much losses for so many years, but once they became profitable, they became really profitable. So some companies use a strategy of forfeiting profit for revenue growth, and that's what they're doing. And they're doing a good job at it because they're growing their revenue really nicely. Other companies that forfeit profits that have minimal revenue growth, 10-20% a year, aren't doing that great of a job. They tripled their revenue from 2017. You can see the company IPO'd in 2017 and the stock was pretty flat for a while. I'm sure a lot of people got upset when they bought it at the IPO thinking it was going to go way up, but waited 2 years, maybe a few months, and just sold. But if you would have held out, you could have made a really nice return. And they have a beta of 1.28, so the stock moves a little more than the market. The stock has gone up 250% in the past 52 weeks, much more than S&P 500, which went up 16% in the same time frame. The 52-week low was $8, the high was $65, and the stock is trading above its 50-day and 200-day moving average. This is a really liquid stock. 20 to 30 million shares are traded each day. 62% of the shares are held by institutions, and 5.5% of the shares on float are shorted. If you invested $10,000 into this company when it IPO'd, you would have been down for a long time, but if you held out, you would have more than doubled your money. The owners of the company own the most stock, then T. Rowe Price, then Vanguard, then Edgewood Management. Let's look at their financial ratios. The average PE in the market's 9, the median is 14. PE is stock price over earnings per share. To calculate earnings per share, that's net income over shares outstanding. They have negative net income, so they have negative PE. When a company has negative PE, you look to the price to sales ratio. Price to sales is stock price over sales per share. They're 37. So investors are paying $37 for $1 revenue. Price to book is stock price over book value per share. They're at 40. And the way you calculate book value per share, it's equity over shares outstanding. Equity is assets minus liabilities in the balance sheet, and they have $2.3 billion of equity, $1.3 billion of tangible equity, because they have $1 billion of intangible assets on their balance sheet. Intangible assets occur when you acquire another business or merge with another company. Interest coverage ratio is EBIT over interest expense, negative EBIT, negative interest coverage ratio. ROE is net income over equity, negative net income, negative ROE. Current ratio is current assets over current liabilities. They can easily cover their current liabilities with their current assets. And their current assets are $2.5 billion of cash and $700 million of receivables. So the company does seem to be well capitalized. Even though it had negative free cash flow, it has $2.7 billion of working capital. So they have about $2.5 billion of funding. And I think they will have positive free cash flow in 2021. The best way to look at ratios to compare them to similar companies, I've done videos of 14 companies in the same industry as Snap. And if Snap has a number in red, they're worse than the average. If they have a number in green, they're better than the average. So they're worse in all the price multiples. They are better in current ratio. They're a lot higher in debt than average. They are a really big company, but half the size of the average in the industry because Google is in this industry and so is Facebook. So to summarize, I have them trading at a 36% premium, but I think this is a great long-term hold. I think this stock will definitely go up over time. It has such a big user base. And I rank their free cash flows 1 out of 10 because they're negative every year. I rank their revenues 9 out of 10 because they've been growing their revenue a lot every single year. And I rank their ratios 1 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.